So, looking at the markets, realistically, when you think about the roller coaster ride we've been on over the last 6 months, right now we're in a pretty good shape. I've always said if we're going to have a downturn in the market, let it be in the beginning so we end up with a good year. And that looks like what we're going to be feeling this year. The beginning of the year was up and then it came down. Right now, the S&P 500 as of the end of June is looking at a 6.2% increase for the year. International and emerging markets have really kind of pushed forward. They're in the high double digits, so everything's working well there from a return standpoint. Going down to bonds and alternatives, just really looking at the U.S. aggregate bonds and then gold. Certainly a big difference between the two right now. Both of them are considered relatively safe havens in the time of uncertainty, but you can see gold is up about 20% more than bonds. But looking at the fact that we're in a secular bear market for bonds, year to date at 4%, that's actually a very good number. And then if you look at the global markets again, now we're looking at global equities and global bonds mixed together on a 60-40 portfolio. Realistically, they're having a pretty good time because of the fact that the international and emerging markets are doing so well. Now, if you look at the S&P 500 and you kind of break down the sector's returns, we've got a pretty wide spread between the top flyers, which is really industrials and then utilities, technology. They're all running very, very high mid-year. Where we do see a bit of a drag is in healthcare and consumer discretionary, which is actually coming in rather negative. On the other side of the chart, the blue side, which is just over the last week, we're actually looking at experiencing some sector rotation going on. And you can kind of tell here your energy, which was year to date sitting lower to the bottom, has actually jumped to the top as far as returns for last week. And then if you look at financials went from the middle of the pack down to a negative on the bottom of the pack. Again, I think we're seeing a little bit of rotation in the markets. You're probably seeing some rotation in the portfolios right now as the institutional money managers start taking advantage of some of the good buys out there right now. Now, if you think about volatility and you're looking at U.S. stocks versus bonds year to date, this chart kind of tells the story of volatility, risk versus return. The S&P obviously hit a high in the beginning of the year. And then we took this, what we would call a healthy correction, which was primarily news related, and that was driven primarily by the tariffs. The market dropped below 16%, but it has certainly rebounded back, and we're actually hitting new highs again. But you can see it was a very big roller coaster ride in that 6-month process. When you look at bonds, which bonds tend to be more conservative, a little safer, they stayed pretty much in a 2% channel throughout that whole time. Took a little bit of a dip the same time the S&P and the markets had dropped, but didn't drop down too far at all. Now let's mix in a little bit about the European markets. The European markets on this chart, you can see the S&P 500 over the last 5 years has really pulled out almost 100% returns. You look at where the European Union is and you're wondering why there's so much investments going on in the US. Well, look at the returns for the European Union. There's not even half of what the S&P 500 is. And then also you go down to bonds, knowing that we're in a secular bear market for bonds. The bonds are literally running a negative over 16% over the last 5 years. And it certainly is putting a drag on portfolios. And the more conservative you are, the bigger the drag is. And